I did a 90-day pause for the people that didn't retaliate, because I told them if you retaliate, we're going to double it. And that's what I did with China, because they did retaliate.
President Trump's 90-day pause on most higher tariffs set to send Asian stocks soaring after Wall Street's best rally since 2008. That decision coming after days of mounting stress in financial markets and a chorus of pleas from the president's own billionaire backers. That about-face triggering huge swings in bonds, the US 2-year yield briefly spiking past 4%, while 30-year yields wipe out an increase. The president, though, excluding China from his trade war reprieve, raising duties to 125% after Beijing's latest retaliation.
This is the Asia Trade. I'm Shery in Seoul with Haidi Stroud-Watts in Sydney. Take a look at how U.S. futures are coming online after we saw that huge surge overnight. We're talking about the best day for the S&P 500 since 2008. Nearly every stock in major indices gained ground. The VIX actually saw the largest drop ever. President Trump, before announcing the tariff pause, actually on social media telling investors to be cool, that this is a great time to buy. We saw that Treasury sell-off continuing, easing a little bit, but still down across maturities. That deepening losses really bringing into question the safe haven status of Treasury's 2-year yields, briefly spiking past that 4% level. Take a look at how Asia is setting up as well, because we saw those tariffs being raised on China, but even so, the offshore yuan did rally on that broader risk rally that we saw around the world. The PBOC weakened the yuan's daily reference rate for 5th straight session. So we continue to see this moderate pace of adjustment, guiding lower for the Chinese yuan against the U.S. dollar. You can see it trading at that 734 level, as Nikkei futures are now pointing to the upside after they fell in the previous session. The Japanese yen also gaining moderately, but after weakening on that risk rally around the world. We are watching yields soaring across Japan as well. We are getting the PPI numbers later this hour, and of course we'll be watching if the Kospi also emerges from bear market territory. Keep an eye on the Kiwi dollar. It fell to the lowest since 2020 after the RBNZ also cut rates. Heidi.
Shery, as you mentioned, just hours before the announcement of his tariff pause, President Trump posted on social media that it was, quote, a great time to buy, foreshadowing the historic turnaround in stock prices. More than 30 billion shares worth $1.5 trillion changing hands across U.S. markets. It is a record in Bloomberg data going back to 2008. But let's sort of pass through all of this with our team. In Sydney, we have Garfield Reynolds, who leads our Markets Live Asia coverage. Our Bloomberg Global Economy correspondent, Enda Current, joins us from Washington, and our China correspondent in Minlo is with us in Hong Kong. And let me start off with you. So we see that relief rally, right? But how much of a reprieve is this 90-day pause, particularly given we continue to watch the economic and political decoupling when it comes to China and the US play out in real time?
Well, it's a dramatic headline. It is a pullback of those reciprocal tariffs as they are so described on, the 60-odd nations around the world. It gives them 3 months to go and work out a deal, brings things up to July. But when you step back from that, Heidi, to your point, the 10% minimum tariff is still in place, which in and of itself is already a shock to the system. But most importantly, the US has now put tariffs on China. It's second, maybe third largest trading partner of over 120% of all goods coming in. And of course, China responding with tariffs of 80-odd% on US goods too. This means that the world's two biggest economies are now locked in a deep trade war. There's no hint of a near-term off-ramp. For the US economy, that will surely mean higher prices near-term with consequences for consumers and, of course, business sentiment too. And on the Chinese side, obviously, it will impact growth there, especially in the manufacturing sector. So it's a kind of a big headline. But under the bonnet, tariffs remain sky high and the US remains locked in a trade war.
Yeah, which is what makes the market reaction pretty surprising, right? I mean, Garfield, we knew that investors were trading on headlines, but what do you make of this huge rally overnight?
Well, we had a prefiguring of what could happen when the alleged, back then it was fake news, when there was a tweet from a rather weird anonymous account saying that Trump was going to impose a 90-day pause, and then About a day later, he did. So there you go. Markets have been in panic mode. If you think, I would argue that where we were before this happened in markets, there was still plenty of downside if you did indeed get the tariffs just going ahead as they had been announced. But what was, at least partly in the price, was the potential that something like this would happen. This, after all, was what happened with Mexico, what happened with Canada. You had a series of 30-day pauses, and we still effectively have a pause on most of the tariffs that were initially announced against them. So to have a pause on these reciprocal tariffs, not a huge surprise, and also, therefore, something the market was looking for, and it's understandable that shares have come back up. I also think this is a bit of fool's gold going on. Enda pointed out, the way that there's a large amount of difficulties that still remain. These tariffs are still a huge hit to the U.S. economy, to the global economy, and then setting aside the tariffs. If we just had these rates that are in now, and these had been arrived at in a transparent, logical manner and pushed forward in the way that says, okay, these are going to be in for the next year while we assess what's going on, that would be bad enough. But to have a 90-day pause, and now we're open to, 60 bilateral sets of negotiations, complete with headlines, with Trump might say, well, Korea's been talking well, but they haven't offered me anything phenomenal, so I think we'll still end up going ahead with the tariffs that we'd said we would impose. Huge drop in Korean stocks, huge drop in any equities of companies that are dependent on Korea for a large part of the supply chain. Or, the inverse, he says, yeah, Korea's offering something phenomenal, so we're just going to take tariffs fully off the table for them, and you get the inverse moves. And that is what we can get going across the globe. So how do businesses plan in that sort of environment? Rather than spurring companies to bring their factories to the US, to bring their business to the US, there's the potential that this will be something that will get them to do the opposite, to stay away from the US. And if you're a foreign investor, how happy are you going to be about keeping your money in a country where the decision-making process is this opaque and this volatile?
Min, when it comes to what we're watching out next from Beijing, obviously with US tariffs on China now soaring into the triple digits, the view seems to be there's not much left on the tariff and trade escalation front. What other weapons could Beijing possibly deploy when it comes to its currency or perhaps Chinese ownership of US assets that we should be keeping an eye out for?
Yeah, when it comes to the currency, we will be looking out for what the fix would be today. And clearly, China will likely continue to allow that moderate depreciation of the yuan. But just given the scale of the tariffs so far, you would need to depreciate the yuan by a lot to fully offset that. Even a 10% depreciation would be considered a small amount. But there has been a lot of commentary about how, in some ways, China's hands are tied when it comes to the yuan, because it would cause shocks to the Chinese capital markets, huge outflows. We have already reported previously that China had been telling companies to put on hold, or rather putting on hold any approval for Chinese companies wanting to invest overseas. Meanwhile, we had also reported that the Chinese government had been asking firms like Shein and others to put on pause any plans to move their supply chain overseas. And it looks like at this point, China will want to ensure the continued competitiveness of its supply chain by ensuring that they don't see an exodus of manufacturing overseas, while at the same time preparing to fight both diplomatically and economically. There's a lot of expectations that China is going to front load stimulus in the coming weeks. We could hear more from the April Politburo meeting, perhaps more rate cuts to come, cuts to the triple R ratio, and continuing to deepen their trade ties with other countries, with presidency planning to make a trip to Southeast Asia, the recent call with Ursula von der Leyen in the EU as well. So all of these sort of moves in concert to try to protect and support the Chinese economy.
And given, of course, a tit-for-tat between the U.S. and China and it's perhaps not surprising that Secretary Scott Bessent is now warning the European Union from pivoting towards China. In fact, he said he's warning them that that would actually, quote, be cutting your own throat. How surprised should we be? The relationship between Washington and the European Union seems to be deteriorating so much.
Well, we had the EU Trade Commissioner here twice over recent weeks, and in one of those events that I was at, he made it very clear that the EU is willing to bring down tariffs, buy more LNG from the US and do other measures to prevent tariffs going ahead on the European Union. But that happened anyway, and that clearly soured relations. You saw the tone turn negative between them over recent weeks. And that's true from all of the trading partners in terms of those you would class as allies of the US, Shery. And I think when you listen to Treasury Secretary Scott Bessent this morning, he made this point. He made a brief remark at an event here this morning that there's potential to do deals with plenty of countries, including, the trading allies. And once they get that done, then they can turn towards China as a group. So this idea that maybe there can be some kind of a trading alliance with the US, and then they can start tackling China together and some of those problems, such as, overcapacity being the common complaint. But to be clear, a lot of this is vague. It's still quite early. If there is a strategy, it isn't being articulated especially clearly. There is clearly confusion in markets and in businesses. What we do know right now is the US seems consistent with this idea that if you don't retaliate, then maybe we can do a deal on trade. If you do retaliate, we'll respond in kind. And that seems to be where we've gotten to in terms of China and the US, and then the US and everybody else.
Garth, we heard Scott Bessent refer to what he thought was normal deleveraging when it comes to bond markets. It was a couple of sessions of sort of mayhem at some points, right? And I wonder, do you look at the risk that maybe Chinese holdings of treasuries might be something that's on the table, or what happens with the yuan?
Well, that seems unlikely, because that really would be, in many ways, China, cutting its own throat. It holds a lot of treasuries, and if it was to dump them, it would almost certainly be dumping them at a pretty low price, and that would do all sorts of things to complicate, its attempts to keep control of the yuan. I also, one of the things that struck me when those rumours were flying around yesterday that maybe this is China doing this, was that, well, if China was going to do it in order to punish the US, wouldn't they make it clear that they're doing it? They could actually sell very little and make it clear that this was a protest and get a very big effect. So I think this was more about, whatever the particular spark might have been, quite possibly people selling treasuries in order to cover losses, severe losses on other assets. We got moves that squeezed out some of these big leveraged bets in treasuries, and Treasury Secretary Bessent said this was normal deleveraging. This was at the absolute extremes of what might be called normal. At one stage there, it seemed like there was basically almost no buyers for 30-year bonds in particular. I was looking at this yesterday, and at one stage yesterday, the 3-day gain in the 30-year yield was the largest since 1985. Even worse than what happened when you had the pandemic-era meltdown, which was very much about basis trades unwinding and was deemed to be so abnormal that the Fed and others, probed those moves and came up with some recommendations about the need to try and discourage these sort of leveraged trades. So I think that was a lot of what went on. I also think you have to ask yourself if the Trump put these days might not refer to the bond market rather than the stock market. Secretary Bessent did say that he watches the 10-year yield, not the cash rate. Donald Trump on the election campaign talked about bringing interest rates lower, and the 10-year yield is seen as being the interest rate when it comes forward to the real economy. So the bond vigilantes might not be back, because this was less about people selling because they thought that the US government's fiscal path was unsustainable than it was about people being forced out of positions. But watch the bond market maybe when you want to judge if President Trump might change tack.
Yeah, because as we've been talking about, I mean, there were even concerns that China could be selling treasuries in order to retaliate, right? But Min, given, of course, these decoupling fears between the U.S. and China, what are some of the latest that we're hearing about more moves from both sides to actually really retaliate against each other? I think we're even hearing about Beijing cautioning citizens about traveling to the U.S.
Yeah, that was the latest we got yesterday. The Chinese government cautioning citizens to think twice before boarding a plane to the U.S., just given the ratcheting up of trade tensions. The Ministry of Education also warning students to think about the risks, especially given the bill in Ohio, for example, that is cancelling any sort of provisions for DEI. And so you can feel that it's already spilling over to the people-to-people exchanges. And China hasn't responded to the latest round of escalation because all these took place overnight in Asia. We're likely to hear something from China today, but if we consider what China's position has been so far, and if they remain consistent, they are going to, quote, fight till the end. And we saw yesterday, hours after the reciprocal tariffs kicked in, China raised the levy on U.S. goods from 34% to 84%, basically topping up the additional 50% to match what Trump has done. So they may perhaps consider topping up the additional 25% in the latest round of retaliation to bring the total tariffs up to 109 or so, if my math is correct. Yes. So we'll have to see. But you also got to wonder whether, this was part of Trump's grand plan all along, whether he sort of goaded China into walking into this trap and then giving a reprieve to everybody else, leaving China to hold the bag, and how China will respond to such a situation. And it looks like this thing is just going to continue to escalate into a prolonged standoff if neither side looking to back down.
Garfield's Bloomberg's Mimi Lo, also Garfield Reynolds and Curran. Good to have you with us with that roundup of everything that we need to know around these Trump tariffs. Coming up on the Asia Trade, we'll be discussing them more with BNP Paribas, not to mention Defiance ETFs as well. Plus, former U.S. diplomat Susan Shirk shares her views on the trade war escalation between Washington and Beijing. Much more ahead. This is Bloomberg.
Take a look at what we're watching when it comes to some of these major tech stocks. As we saw, of course, that big rally that we saw overnight, really that relief rally. The question is really how long we see this being sustained for in terms of the soaring that we've seen in stocks. Bonds, of course, continuing to swing. The best day broadly for US stocks since 2008. The Nasdaq 100 in particular seeing that jump of 12% after the pause on some reciprocal tariffs being announced by President Trump. This is what we're seeing when it comes to the session at the moment for the big tech names. Amazon, for example, up by 12%. We're seeing some of those exporters and really China-sensitive names actually seeing a bit of a reprieve as well, which is quite interesting given that we know that for the likes of Nike, for Walmart, for example, those structural difficulties when it comes to their supply chains will continue given that there's no reprieve for China. In fact, we've seen that further levelling up of tariffs on China to 125% for some Chinese goods. Let's bring in now for what we're expecting when it comes to these markets ongoing with Sylvia Jablonski, who's a CEO and CIO at Defiance ETFs. Sylvia, great to have you with us, and we appreciate your time during such a frenetic week. Does this 90-day pause give you any sort of assurance that the intentions of the president and trade policy are clear, or is it just going to be 90 days where we continue to see reaction to headlines, to commentary, to ongoing developments and uncertainty?
Well, thanks so much for having me. I think it's an interesting question right now because I do think that uncertainty remains, right? So if we look at what happened today, is this kind of like high stakes poker, come in hot and dial back so that you can get everybody to the table and kind of, negotiate? You just throw the throw the equilibrium off of balance, and then you kind of get to where you need to be. So I think that, that's what it felt like today. And there were a couple of things that came out of today. It gave the market some confidence that there is still a Trump put. Gave the market some confidence that this isn't, completely unhinged and unleashed, and that there is, some attention being paid to equity markets regardless of what's being said. But to your point, what happens in the next 90 days, right? Do we end up right back in the same place where the deals aren't the way we wanted them to be? What happens with China? So I think what we're going to see in the next 90 days is continued volatility. I don't think that this was like a clearing event and we're good to go for the rest of the year. But, the other lesson that I'm reminded of is, dip buying on days when markets pull back 10, 15, 20%. And by the way, S&P and NASDAQ are still 15 and 18% off of, off of the year. And so you still have these opportunities to get into markets and participate in these days. If you're not in them, those one-day rips, these are the days that you miss out on. So a couple lessons were learned today, I think.
Yeah, Sylvia, if you want to take a look at just how strong a stomach you need to have in terms of the levels of volatility that we've been seeing, this chart on the Bloomberg showing the S&P 500's 10-day volatility level surging to among the highest that we've seen in the last 100 years. So it's only been above 60 a handful of times. The pandemic, the GFC, Black Monday in 1987, as we headed into World War II, and of course the Great Depression. And we're also seeing that daily reversal on Wednesday hit nearly 11%. This is the biggest swing since the global financial crisis as well. So does this tell you that volatility and these wild swings and mayhem will continue? And if so, how do you invest around that other than really kind of having to dig into stock picking, but also with more of a medium and long-term outlook?
Yeah, and that's a great point. Well, what was interesting about today is you had the biggest rip since 2008, right, in the S&P, and you also had the biggest dip in the VIX in a really long time, right? So volatility kind of fell off today. And again, I think it goes to you should remain in the market. If you don't need the cash to live on day to day and you can remain invested, let the Mag 7s recover. Don't take these massive losses. The recoveries and rebounds, we don't know when they come, but most recessions, if it ends up being a type of recession situation, don't last for longer than 6 to 12 months or so. We saw today was a quick recovery. Hopefully that leads us to a more stable market, and the rest of the year, as we get clarity, around tariffs and things like that, we can continue going back to growth in GDP and increasing corporate earnings and S&P performance. But to answer your question, like what would I buy? I would go back to what happened before tariffs. So what was happening? Mag 7, everyone has it, and it's great. Keep it in your account and hold on to it forever. But when you want to put new money to work, right, Mag 7 wasn't what was working, right? So you go X Mag. Or you can buy on the dip for the names like Quantum and AI that got hit the worst the last couple of weeks. So there's a lot of places to put your...
Do you buy into any of those traditional safe havens? Because there are now questions about the safety of treasuries at this point.
Yeah, I mean, I think that it goes back to just having a broad, diversified portfolio, and there's different ways to diversify. So, you can have fixed income, you can have treasury exposure. You can also look at things like gold types of products, gold with options on them, things like this to get some income. There's a lot of ways to diversify portfolios if you're not kind of, happy or uncertain about treasuries. But it's a great point. I think that this is an uncertain market. And that's why as an investor, I think long-term is the best way to look at it. Short-term, you can definitely buy these rips and dips and use levered ETFs. And, short-term tactical traders have done quite well with that over the last 24 hours. But for the average investor, having broad-based exposure is the way to go.
Sylvia Jablonski, always good to have you with us, CEO and CIO at Defiance ETFs. We have more to come. This is Bloomberg. Take a look at how U.S. futures are trading early in the Asia session. We're seeing a little bit of upside after that historic rally overnight. 30 billion shares worth $1.5 trillion were traded on Wall Street. More ahead on the Asia trade. This is Bloomberg.
every country in the world who wants to come and negotiate, we are willing to hear you. We're going to go down to a 10% baseline tariff for them, and China will be raised to 125 due to their insistence on escalation. I'm not calling it a trade war, but I'm saying that China has escalated, and President Trump responded very courageously to that, and we are going to work on a solution with our trading partners.
U.S. Treasury Secretary Scott Bessent speaking about the decision to pause most higher tariffs while hiking those on China to 125%. Let's bring in Teresa, an associate professor at Dartmouth College, where she focuses on international trade. Teresa, great to have you with us. So how do you expect businesses to be able to react to these unpredictable tariff measures coming from the Trump administration?
Yeah, I think you've really nailed it with the fact that these are unpredictable. So the big issue is going to be that having told businesses and Americans that these tariffs were going to be permanent, that they were not a negotiating tool, now they've been rolled back. And I think that just highlights the amount of uncertainty that businesses are facing right now, and how do they handle this type of uncertainty. There's no sense in which a business could look ahead and say, well, we expect tariffs to be this amount, and so we're going to go ahead and make a long-term investment decision that is millions or even potentially billions of dollars to build a plant. So I think that this is going to be very hard for businesses to plan at all.
Do we have any idea at this point what would be the sectors most affected and perhaps immediately affected that could also have an impact on the broader economy?
Well, I think there's a lot of firms that source from China. I mean, we know for consumers that China is a major source of goods. So firms like Walmart, firms like Target are clearly going to be affected pretty quickly and with big negative impacts. I mean, this idea that foreign firms would bear the cost of the tariff is not completely unfounded when it's a very small tariff, a 10% tariff. There would probably be some sharing of the cost between domestic U.S. firms and the foreign exporters. But tariffs of the magnitude we're talking about here, there's really no chance that firms, especially firms in some of these very competitive industries, are operating with margins that are anywhere close to the size of the tariffs. So they're going to have to pass those costs on. And in many cases, there's probably going to be firms that simply cannot afford to buy from China anymore. So I expect to see big firms suffer, have their margins, their profits fall considerably. And then I expect to see smaller firms that just don't have the cash and the wherewithal to withhold these to have to exit. And you asked about sectors.
It's interesting when you take a look at...
Oh, sorry, go ahead.
No, I was just musing. It's interesting when you see the reaction on Wall Street, obviously that relief rally, but it's a very different picture and implications for Main Street, right? Because with these 125% levies on many Chinese goods, there's no relief coming when it comes to the US consumer and household spending.
No, I think that's right. And you've seen a lot of consumers rushing out to electronic stores. My children and I actually went and bought a TV over the weekend because we decided it's now or never. I think that consumers are aware of that. What is going to happen for companies like Apple, who are these computer and electronics manufacturers, and they cannot simply switch their supply chains even in 3 months. So this is going to have a big negative impact that I think is going to ripple through the economy, both for consumers and also for businesses.
It says a lot when a trade expert is front-loading their purchases right before they kick in. But Teresa, I do wonder, you talked about the implications for some of the big China-exposed firms. Obviously, we've been watching the likes of Target, Walmart, etc. How much bargaining leverage is there? Because we know that some of them have been trying to pressure their factories and supply chain partners in China to at least absorb some of those costs from the tariffs on their side.
I mean, I think the bigger firms do have bargaining power and they have longer term relationships. But like I said, if you were talking about a tariff of 10 or even potentially 20%, firms may have some margins where, at least in the shorter term, they can still potentially cover their variable cost and be able to absorb a lot of the tariff. I just don't think there's any world in which we think that firms' profits are their margins are 100%. So I think that it's just not going to be feasible to do the kind of price absorption that they have in mind. I also think that it's counterproductive to have made the tariffs so high, even if your motive was to raise revenue, because I think, again, you're just going to see purchases stop on a lot of goods. These are going to be prohibitively high tariffs.
Teresa, and of course, we know that the strength in the U.S. economy also lies in services. Do you foresee foreign companies applying pressure on America through services trade?
Well, I definitely think that the current policies have focused exclusively on goods trade and seem to have this motive to balance bilateral trade in goods across all of our trading partners, which ignores the fact that the U.S. is a net exporter of services. And so for us, our comparative advantage here is to produce and sell these services abroad. I think that it's certainly an area we've heard the EU talk about considering certain retaliation on the services side. We know that U.S. firms sell, especially service firms, let's say the tech sector, for example, of the firms that are in the S&P have the majority of their sales are outside of the United States. So I do think that that is an area in which, if they chose to do so, foreign countries could retaliate against the U.S. I will also say that I think that a lot of the services that we produce and export are complementary with the low-cost manufactured goods that we can buy from foreign countries. And so I actually think that we don't perhaps realize how we are hurting our own service sector by targeting imported manufactured goods in this way.
I wanted to ask your view when it comes to, this sort of idea that you can return to a golden age of US manufacturing. Is that desirable? Because is that not a consequence of economic progress, that it is a consumer-based nation as opposed to a manufacturing nation? And is it even possible from the perspective of, input costs, infrastructure costs, labour market availability?
I mean, we have certainly seen that both the Republican and Democratic administrations have pushed to bring back manufacturing to the United States. Now, I think that's a very broad statement. And so we want to ask ourselves, well, what type of manufacturing do you have in mind? And so the CHIPS Act and the Inflation Reduction Act were both geared at providing subsidies to firms that were going to open manufacturing plants in the United States. And we've seen firms try to do that. I think that we are overlooking the cost of trying to produce everything in the United States. That's not really viable. And in fact, what you had been seeing prior to the Trump tariffs that have just been put in place was that manufacturing firms were having a hard time hiring labor and finding the workers to make their factories work. We saw failed attempts by Foxconn to open manufacturing plants, for example, the one that they tried and failed to open in Wisconsin. And so I think that it speaks to a lack of understanding of the fact that we have constraints. We have a certain number of workers, and how do we want to allocate those workers? And do we want to allocate them towards those activities that the U.S. is relatively good at, which is going to lead to more growth and higher productivity? Or do we want to reallocate them towards sectors like textile and apparel, where I think it's pretty clear we don't have a comparative advantage?
Teresa, really great to have you with us, Teresa Fort, Associate Professor at Dartmouth College there. Let's take a look at what we're watching when it comes to commodities markets in particular, because we did see that really big sort of wholesale move across a multitude of commodities, including the likes of even coffee and soybean, for example. But take a look at oil. We've seen this sort of much anticipated rebound after that 4-year low for crude, after we saw the change in tactic from President Trump, the pause on some of those tariffs for 90 days there. We saw WTI just rising there and up by just about 1.25%. The best one-day gain since October, but of course still a lot of turmoil when it comes to the demand outlook for crude, particularly given that we've seen those tariffs not only not seeing a reprieve for China, but also being escalated, and a lot of question marks when it comes to Chinese demand there. This is a picture when it comes to some of the other commodities that we're watching. Gold also seeing a little bit of an upside there. Soybean, interestingly, upside of 2%, despite, of course, this is one of the key agri-commodities that are going to be affected by those US-China tariffs. And we have seen quite a lot in terms of wild swings in soybean pricing as well as corn pricing over the past few sessions. More ahead on the Asia trade. This is Bloomberg. Well, Japanese stocks are set to surge after the US paused higher tariffs for 90 days. It comes with, along with two senior Japanese officials already in Washington for trade negotiations. That's bringing Bloomberg editor John Herskovich. So a pretty significant meeting that we saw among officials from the Bank of Japan, Finance Ministry, the Financial Services Agency, and it kind of underscores a degree of consternation over the market volatility and sell-off that we've seen in the days leading up to today.
Meetings of this sort are rare. I think the last one was in August of last year, and it's just signaling to markets that during financial turmoil, that authorities are ready to step in. And we've seen gyrations in Japan, like in other markets around the world. The yen, as a safe haven bet, reached a 6-month high. JGB yields are up. And the stock market has plunged accordingly, and we're set for gains today. So there's just like the topsy-turviness of what's going on in the world hasn't escaped Japan, and this is one of the reasons why we've had the meeting. But the key thing as well is the Bank of Japan. Economists are seeing what's going on as putting a pause on any moves towards BOJ normalization. Some are looking at the possibility that we won't see any rate hikes anytime this year. So just a lot going on in Japan, as there are in major markets around the world.
Yeah, we even heard from the top currency official, Mimut, expressing deep concern about just the market fluctuations, especially when it comes to the Japanese yen. But John, so what are we expecting the delegation headed to Washington to actually offer?
Yeah, for the delegation itself, we're trying to see if they can get some understanding from the U.S. about what's going on. When it comes to the actual tariffs, I think Japan's tariffs on U.S. non-agricultural products are about 2.5%. The tariffs that were applied this week on Japan are about 24%. So there's an imbalance there. So I think Japan is going to try to seek understanding from the U.S. on the situation. But things are fluid. Everything is moving quite quickly with this. What Japanese officials were looking at now could change. And the U.S. has its own ideas of what it wants from Japan. It's looked at Japan's tariffs on agricultural products, which are quite high. Trump says he wants the U.S. to sell more cars in Japan, and the U.S. officials have been pressing Japan to step up purchases of liquefied natural gas. So we have some pressures from the U.S. and some thoughts from Japan that what's going on just isn't fair to the country, which has been such a close partner to the U.S. for so many years, and is also key for the U.S. for any moves that it wants to make towards China.
John, is Japan truly out of the woods when it comes to these tariffs, because we're still contending with those auto tariffs?
Yeah, exactly. Japan is far from out of the woods on this. Just for the auto tariffs, we've seen some changes in Japan with shifting of manufacturing. Japan has facilities in the U.S., Canada, Mexico. There's been some internal shifts in production there. But we have the auto parts tariffs, which I think are coming on next month. And this could really hurt production because parts of key components of engines, drivetrains, a lot of which come from overseas, Japan or Canada or Mexico. So we could see cars produced in the U.S. being hit with these tariffs, and this could hurt U.S. manufacturing, could hurt U.S. jobs. And also, we just don't know if Trump's going to throw in a few curveballs. He's been seeking more money from Japan for security. This could be one of the conditions that comes in with these talks. We just don't know what will be attached to it. So Japan is far from out of the woods. The auto tariffs are there. There's more to come. And there's just the element of the unexpected. And as we've seen over the past few days, we can expect the unexpected.
Bloomberg's East Asia government editor John Herskovich there as we head into just a few minutes away from the start of trading in Japan. But we do have some breaking news when it comes to more high-level appointees, this time for the SEC. The Senate has confirmed Paul Atkins for the Securities and Exchange Commission. That nomination had been advanced by the Senate Banking Committee previously to lead the SEC. So this is quite interesting because Paul Atkins is expected to rein in SEC enforcement when it comes to playing a major role in shaping new regulations for digital assets, for example. It has been quite a controversial appointment. He was the Republican SEC commissioner from 2002 to 2008, but a lot of concerns, Shery, when it comes to conflicts of interest, because he has worked for various companies that have been regulated by the SEC, including financial services companies, crypto firms and the like, and critics say that this is a conflict of interest.
But Haidi, South Korea also seeking a big trade deal with the U.S. after a phone call between acting President Han Duck-soo and President Trump. For more, let's bring in the Asia Stocks reporter Yoo Kyung-lee. Yoo Kyung, I mean, the trade surplus of South Korea against the U.S. has been a big issue for President Trump. What are we expecting to be the low-hanging fruits that they could cooperate on?
So in 2024, the trade surplus was between the United States and South Korea was $56 billion. So South Korean officials will bring some comprehensive packages that could get them lower levy, which now at 25% reciprocal tariffs, and that includes a possibly increasing energy exports such as LNG, and also increasing cooperation on the shipbuilding sector or Alaska gas pipelines. And there's also the issue of the sharing the cost of the U.S. troops staying stationed in South Korea. So those could be some of the issues that could be on the table as the commerce officials between the two countries speak.
And of course, all of these concerns have led to the Kospi to actually enter bear market yesterday. Could we expect a little bit of a rebound given the broader risk-on sentiment today?
Yes, absolutely. So I think those gut-wrenching panic sell-off day might be behind us, just for at least for today. We are already seeing a huge rebound in some of the shares and the pre-trading, such as like SK Hynix rising like 14%. So when the market opens, we might actually have to be prepared for a possible trading help that can be triggered if the Kospi rises at least 8%. So we'll be watching for that. And if the circuit breaker is triggered, the trading will be halted for 20 minutes as a measure to tame the volatility. But we're definitely expecting a big rebound today.
Yeah, especially given what we saw on Wall Street. Bloomberg's Yoo Kyung-lee here with the latest, Haidi.
Well, Australian stocks, Shery, also expected to open strongly today following President Trump's decision to pause those higher tariffs for 90 days for most of these trading partners. Bloomberg's Paul Allen joins us now. So Australia still faces that baseline 10%. But perhaps more significantly, there's also the China exposure.
Yeah, absolutely. And this is all very much top of mind for the Treasurer, Jim Chalmers. And yesterday he called a meeting of a body known as the Council of Regulators, which includes the RBA, APRA, ASIC, the Consumer Commission was involved as well. And they noted that, this is a very volatile time and they expect that volatility to persist. And just underscoring that, not that much longer afterwards, President Trump paused those tariffs. So in the meantime, we've got Treasury modelling a 0.1% hit to GDP, which is pretty modest. But we're seeing consumer confidence cratering this week. Markets are now pricing in a 50 basis point rate cut in May. But against this backdrop, the financial regulators note that the system in Australia is strong. The banks are resilient, really well capitalised. And yes, as you point out, Australia only got hit with that 10% baseline tariff. But the greater concern is China and what appears to be an escalating situation with the US.
We've seen so much outreach from Beijing, right? And now this sort of, olive branch is saying that Australia and China should now work together. I mean, to be fair, that relationship has improved a lot since where we were 5 years ago.
It certainly has. And it's interesting, isn't it, that we get that op-ed today from the Chinese ambassador to Australia, Xi Qian. He's saying that there's no winner in a trade war or a tariff war. Protectionism is bad, and calling on Australia to join hands with China to defend the world trade order. But it's so... look, it was only 5 years ago, wasn't it, that China was putting trade strikes against Australia. Over 200% on wine, 80% on barley, many other products hit as well. So those restrictions are gone, but certainly the memory there remains. But it does underscore the challenge for Australia. China is so much bigger than any other trading partner. It's 4 times the size of the US, but the US is Australia's closest ally. So a real balancing act to be walked here.
All right, Bloomberg's Paul Allen there. As we're getting breaking news out of Japan as well, we're getting the PPI numbers coming in at gains of 4.2% year on year for the month of March. This is beating expectations, also accelerating from the previous month. When it comes to month-on-month number, again, it's also a beat of gains of 0.4% for the month of March. We are now seeing the 10-year yield in Japan also moving higher. We continue to see some risk aversion easing and, of course, a calculation about what the Bank of Japan might do next as we continue to see those price pressures rising across the economy. The year-on-year PPI number, factory gate prices accelerating to 4.2% for the month of March. This is Bloomberg.
And of course, as we see the sigh of relief over broader risk assets and markets that is going to peter through to Asian markets, Shery, the sort of risk of recession, the stagflation risk remains, right, given the heft that we see in terms of trading between the US and China and just really the weight that these two economies hold and the fact that we're now seeing 125% tariffs being lifted for some Chinese goods. So we are hearing from Fed officials really that they discuss the risk of stagflation at the March meeting. Economic growth, of course, seemed to slow despite high inflation, and that last mile of tackling inflation has been viewed as being sticky. Officials at the Fed viewing these risks are tilted to the upside, employment risks as tilted to the downside, and actually in that meeting marked up their expectations for inflation, downgraded their 2025 growth forecast. So it kind of speaks to these lingering worries, despite, of course, perhaps what is potentially a short-term jump that we see in sentiment across risk assets. And if you take a look at credit fear gauges as well, they're showing that worry dropping after we heard news of that 90-day tariff pause. A lot, of course, Shery, will go into what happens in those 90 days, right? The intentions from the president and the administration not entirely clear still at this point.
In the meantime, the uncertainty makes it very difficult for businesses to carry on with business, as well as consumers to sort of decide what to do next, right? I mean, we have seen some consumers rushing to buy things before tariffs are applied and before these electronic appliances become more expensive. But at the same time, because of the uncertainty, you have this chorus of business leaders, CEOs from the likes of Delta, from Walmart, to really warning about that wave of pessimism that could really hurt demand. We already heard from Jamie Dimon talking about defaults that could continue to rise. Neil Kashkari saying also that they're hearing the firms are slowing their hiring. So are businesses already behaving as if they were already in a recession? That, of course, is really a key concern for economists, that behavior could already start to change. We'll cover all of this in the next hour as the market opens in Sydney, Seoul, and Tokyo next. This is Bloomberg. This is the Asia Trade, where Asia market opens after that historic rally overnight. The S&P 500 surging by the most since 2008. President Trump coming out with that 90-day pause of most tariffs. But of course, he did hike those rates when it comes to China.
125%. We did also then hear from President Trump saying that he doesn't think that it could go higher than that. But the point is, Shery, I guess we just don't know. I don't want to pour cold water on, obviously, what is going to be a good day for risk sentiment here in Asia as we open up for trade following on the back of that big rally and relief on Wall Street. But the question is, what happens in the next 90 days? What are the intentions? And, of course, the weight of US-China trade, and that remains like the picture is worsening more than ever.
Yeah, take a look at how Japanese assets are coming online after we saw the yen actually weakening on that risk rally as well. Remember, this week it surged to that October high given haven demand. Right now you're seeing the yen slightly stronger at that 147 level against the US dollar, but you can see the Nikkei coming online up 2% already. We continue to watch some of those sectors that are still going to be affected by tariffs, like automakers as well, because of those tariffs on steel, aluminum, autos were still left in place. We do have some earnings today to watch out for, fast retailing as well. Do keep an eye on the 10-year yield because we've seen yields soar across Japan. The 40-year yield, in fact, soared to that record high. We got the PPI number just a few minutes ago, surprising to the upside, gaining 4.2% year on year. Take a look at how South Korea is coming online because we saw the Kospi, of course, enter bear market territory, down more than 20% from its July high. Look at that rebound today with the Kospi, the Kosdaq gaining more than 4%. The Korean won also strengthening towards that 1400 level. We keep an eye on Samsung Electronics. Of course, we saw them really beating on the top and bottom line this week on their earnings results. But semiconductors, trade, exports, all something that we're continuing to keep an eye on, Heidi.
Yeah, watching Australian assets as we come online as well, because it's an interesting conflict when it comes to Australian markets, given the heavy exposure to China. We saw China presidency really reaching out this idea of Australia and China needing to work together in light of these tariff and trade risks from the US. We had a very interesting op-ed from the Chinese ambassador to Australia as well, just in the last few hours that we've been going through. But we are seeing that predicted sort of upside, 1.4%, perhaps not as hefty as what we might see in other markets. In respect of that sort of tariff pause, approval, I guess, or change in sentiment. But of course, given the massive exposure that we have to China, it's unsurprising that we might see a little bit more of a muted response here. And in fact, the Aussie dollar still continuing to see downside, but we're well off the session lows that we've seen, and that the lows of the past sort of few sessions we'd had have really been trading under that 60 US cent level. But watching treasuries at the moment as well, given just the sheer amount of volatility we've seen in that market. And for that, let's bring in Garfield Reynolds, who leads our Markets Live Asia coverage. Garf, great to have you with us. So I think mayhem was sort of one word to describe what we've seen across markets. There is still no shortage of uncertainty here.
Oh, absolutely. I mean, if you look at the Australian bond market, for example, where 3-year yields, that's the policy-sensitive rate, they tumbled massively 25 basis points yesterday, and then today they've turned around and jumped straight back up. So these are supposed to be safe assets. These are supposed to be where you go for stability and for fixed income, but that fixed income is gyrating wildly along with everything else because global markets are dancing to the rather frenetic tunes that are emanating from the White House, and that makes it very tough for investors to work out where they want to put their money other than maybe just parking it in cash. Then again, there are probably some equity investors out there who regret pulling out or being forced out of their positions over the last few days. And now, do they try and chase this back higher, or do they step back for a bit more clarity on what is going to happen with US-China, what is going to happen with negotiations about individual deals for individual countries over the coming 90 days amid the pause in tariffs?
For today, we're at least seeing really that relief rally for Japan and South Korea, right? Stocks there just surging. A palpable sigh of relief. You're seeing the likes of copper as well jumping over 4%. Which is interesting given how correlated they are with China. I mean, the China side of the equation, how much more complicated does this get if they start looking at non-trade and tariff measures to retaliate?
Well, it can get a lot more complicated. Where does the yuan go? What might China do in response? Will it retaliate? There's been plenty of chatter out there about how, China holds a lot of treasuries. Would they do anything with that? That seems unlikely, but it's a potential stick to wave, as it were. It seems very unlikely that China will back down, at least in the short term. It's going to need at least some time so they can get to a position where the insult level has come down. Many people have said China will not concede if it risks losing face. And at the moment, any concessions would risk losing face given the rhetoric that has been coming out of Washington. And the calculation for China might be, and this actually might be the bigger threat, as it were, to US assets in particular and global assets, is if China makes it clear that as far as it's concerned, these tariffs are going to do more damage to the US economy than to the Chinese economy, especially given China's flexibility in acting to help its economy. The Fed isn't about to cut rates. The PBOC could cut rates 5 minutes from now. No, usually they tend to cut rates Friday evening.
Yes.
So, given that is the potential concern for everybody, is if the realization seeps through that the US may be doing more damage to itself than to China.
Garfield Reynolds there joining us with the latest on what to expect out of the markets as we continue to see this relief rally in the Asian session. We're talking about the Nikkei soaring, almost every sector in the green right now being led higher by real estate, not to mention communication services stocks as well. Of course, we're seeing the Japanese yen a little bit stronger, but after losses in the overnight session, as we had a little bit more of a risk sentiment improvement in the overnight session, the topics also gaining more than 5%. The ASX 200 up 3.8%. The Aussie dollar actually soared overnight, the best day since 2022, after President Trump paused the tariffs on most nations. We're also looking at South Korea, every sector in the green on the Kospi, and we're also talking about the Korean won seeing its best day since December. Let's take a closer look at Korean assets. And joining us now is Ethan Seo, head of global markets at BNP Paribas South Korea. Ethan, really great to have you here in our new Seoul studio. So do you expect this rebound rally, this relief rally to actually last in South Korea given the tariff background right now?
So Trump put is really good thing for us in two parts. First one, 90 days. That's very important. Currently we have an election coming up. It's 2 months. But 90 days period of time, Korea has a good preparation time. It is good time value to us.
Oh, that's really a good point, yes. Right? I mean, they could potentially get a new leader with more clarity and mandate when it comes to negotiating with Washington.
Yes, but the other side, we have some homework, but auto part. So Trump still have a tariff on auto sector 25%. Korea has a 30% export volume to US is auto and auto part. That tariff is still remaining 25%. That's our homework for the next 3 months.
I was surprised at how Trump still applied the tariffs on the likes of, say, Hyundai that announced billions of dollars of investments into the United States. What do we expect in terms of sectors then? The auto sector is one that we're watching. Semiconductors is another big driver of South Korean exports. But what have we seen in terms of the stock market level when it comes to names like Samsung, SK Hynix as well?
Yes. Semiconductor chips industry is so important, but in other side, as a market consensus, maybe US has a little bit cautious approach on chips rather than auto. So chips, even like a Micron has a lot of like overseas factory. So if they apply like a high tariff ratio on chips, that can be a hurt for US economy. So they probably move to auto machinery sector rather than chips. But Korea, still, we have a decent exposure in auto sector. So that's our additional homework for next few months. And then Hyundai, CapEx, that kind of news is very important to us. So overseas CapEx in long-term perspective, that can be impact potential growth in longer run period. So employment in outside, factory building in outside, investment in outside. So protect the onshore market. So government have a look at this kind of like a big transition period.
When it comes to investors watching these stocks, though, does it help that a lot of these companies also suffer from the so-called Korea discount where valuations are lower than peers?
Yeah, actually, like a government own it. There's a retail sector and corporate sector. There's a lot of like overseas investment, especially portfolio outflow, was the main driver of a currency weakness and Kospi undervalue. So there's a few like a project going through, like a KTB, FX, like more like a liberalization, internalization, and then also government has to be focused our retail investor be back home, so at least some part of investment.
Do you expect those trends to continue with a new administration that could come from the opposition?
Yeah, I think so. As long as like a portfolio outflow is so structural, we cannot say portfolio outflow is a seasonal factor. So this is structure. So to net off this flow, to protect our currency, so government has to get some net off flow that's a sticky overseas inflow from to local market.
Not that the Bank of Korea wants to admit this, but we have seen them very concerned about the weakness of the Korean won as well. What are we expecting their policy to be in reaction to the latest gyrations in the markets, the tariff, just the impact on the broader economy?
Yeah, tariff is not a small thing to this manufacturing country, also export driven. So potentially we expect some growth downside in this year, even if like a 10%, 15% tariff applies to Korea. So currency-wise, it should be like a second quarter should be a very difficult time, but BOK already aware. So standalone, so single monetary policy can be a lot of like a side effect we already experienced. For example, like a weaker currency, capital outflow. So that's why like a BOK governor and then a lot of like economists, local economists, keep mentioning about fiscal and monetary policy together. Even some specialists talking about this year, fiscal over monetary policy. That's our current big test.
Especially if we get a president that's coming from the opposition party that controls the National Assembly, then we could see those fiscal measures really ramp up in South Korea, right? How does that affect the markets, especially when it comes to fiscal stimulus filtering through perhaps the bond markets with more government bonds also being around?
Yeah, in general, market expecting some other bull steepening positioning rates curve. Back on this positioning, market expects some fiscal stimulus package. But recently there's some development, even like ruling party and opposition party, so pretty much agree with some other fiscal stimulus package. But in my expectations, so they may deliver some fiscal stimulus package in first half, but additional fiscal stimulus package can be expected in second half as well. So overall, like a fiscal role should be very important this year. So as you know, like a Korea main debt issue is a household debt, not a government debt, and also Korea has a pretty much sound fiscal balance compared with any other country at this moment.
Ethan Seo, good to have you with us here in our new Seoul studio. He's head of global markets at BNP Paribas South Korea. We do have more ahead on the Asia trade. This is Bloomberg.
Did a 90-day pause for the people that didn't retaliate, because I told them if you retaliate, we're going to double it. And that's what I did with China, because they did retaliate. So we'll see how it all works out. I think it's going to work out amazing. I think that our country is going to be at the end of a year or shorter, but I think we're going to have something that nobody would have dreamt possible.
President Trump thereafter pausing higher additional tariffs on dozens of trade partners for 90 days, while also raising levies further on Chinese imports to 125%. For more, let's bring in Bloomberg News Desk editor Jill Desis and our China correspondent Min Lo. And Jill, I was just reading one analyst note that came in this morning who said their neck was sore from all the head spinning that we've seen over the past just 12 hours, right? Jill, what's being made of the Trump tariff pause, other than the fact that we're clearly seeing that market relief rally? Is the president's intentions over the next 90 days clear? Is it also sort of politically being seen as a backstep, or, you know, the fact that pushback has worked?
Well, certainly, Heidi, I wouldn't say that it's clear at all what we may expect over the next 90 days, because we didn't know that we were going to be in this position 24 hours ago. So obviously, the Trump administration is certainly framing this as, you know, this was kind of the whole point, that they've gotten a bunch of these countries to come to the table. You know, they were saying that dozens of countries have come to negotiate. I will point out, though, that, I mean, we're starting to hear, you know, from other countries that say that they haven't actually had these fulsome negotiations yet. They're just trying to, some of my colleagues are reporting on Japan's trade negotiator just really trying to start talks with the U.S., for example. But ultimately, I mean, again, like, you see some of this whipsaw because you've got people like, Treasury Secretary Scott Bessent and others who are kind of saying this is the plan all along. Yet just a few days ago, Trump was talking about how he wasn't going to back down and then he wanted to move forward with his tariffs. So I do think that is kind of playing into a lot of this uncertainty. Obviously, you're seeing this giant relief rally because the fact that you're removing the extent to these, so-called reciprocal tariffs. You're leaving in that baseline one, but you're removing these incredibly high tariffs for at least for the moment is providing some relief. But it still is unclear how exactly we actually see these countries come to the table, make deals with the U.S. Because remember, Haidi, at the end of the day, those original rates that Trump was going to put it into effect that obviously were in effect for several hours just now were based on trade deficit levels and not necessarily the actual reciprocal levels that were in effect. So it's really difficult to figure out how countries resolve their entire trade deficits with the United States.
Yeah, we're seeing really the market continuing to react to these to these tariff gyrations, a back and forth coming from President Trump. Euro Stoxx 50 futures now climbing more than 9% at one point with the pause on President Trump's tariffs. But of course, pause on most countries, not necessarily on China, going up to 125%. Min, how has Beijing reacted so far?
Well, Beijing hasn't reacted to the latest round of tariff, given that it happened overnight for Asia. But there is a regular press briefing by the Ministry of Commerce every Thursday, so we might get some statements from the Commerce Ministry later this morning. So hang tight. But given that China has said that it will fight to the end, it's highly likely that China will continue to match those tariffs from the U.S. Also, given that the tariff levels at this point is almost meaningless, given that there isn't likely to be any further marginal sort of impact, given that the tariffs all in are already at very prohibitive levels. Yesterday, after the reciprocal tariffs kicked in, China had raised its levies on U.S. goods from 34% to 84%. They also added a number of U.S. companies into an unreliable entity list, most of them defense companies. They also added about a dozen U.S. companies into an export control list. But that could be seen as quite a symbolic move, given that many of these companies don't actually have a lot of business in China. You might ask, what else does China have in terms of its toolbox, right? China could, for example, maybe suspend further cooperation on fentanyl with the U.S. They could continue to tighten the restrictions on rare earths or the processing of processed rare earths to the U.S. They could limit U.S. services import to export to China. Still a bunch of tools are at their arsenal, including, of course, depreciating the yuan or even selling treasuries, although these are seen as very last resort measures that would come at immense cost to China as well.
And really, that's what every country is thinking of right now, right? What can they really offer the Trump administration? Jill, tell us a little bit about some of these negotiations that are now getting started.
Sure. I mean, look, again, at this point, it really is difficult for these countries to kind of figure out what exactly may be in play here. I mean, we've reported for the past several days on a lot of the frustrations, particularly out of places like Japan or Korea. I mean, these traditionally very strong U.S. allies that woke up last week to see, additional tariffs of 24% or so slapped on them. And where it really becomes difficult is because Trump has placed so much emphasis on the idea of eliminating trade deficits with nations around the world. That's where it becomes unclear. I mean, do you offer sweeteners for, the U.S. to, taken products? Like, do you remove all types of tariffs? There's some indication that Trump may consider something like a value-added tax a tariff. I mean, where exactly do you stop here? And so that's where it's, we've obviously seen this complete shakeup of the global trading system by the implementation of these tariffs. And even though we do have this 90-day reprieve in place, again, it's still unclear what exactly that looks like. What Trump said today was that, he was really conscious of certain industries and how they may be affected affected by these tariffs. I mean, certainly we do know that a lot of industries are particularly hard hit. So maybe there's some idea of carving out different exemptions depending on the products. But again, it does become incredibly murky when you kind of get into these details of what exactly is the Trump administration looking for that would lead to a full-on reprieve.
Min, we're seeing sort of the starts of negotiations with some trading partners like South Korea and Japan, for example, and the US. But how likely is that with China? Because it doesn't feel like there's a lot of political capital that President Xi wants to expend by looking like he's compromising.
That's exactly right. And actually, Trump has said he believes China wants a deal. They just don't know how to go about it. He said China is a very proud country. And in some ways, it's a very similar sort of description that the White House has used on Trump. White House said that Trump has a spine of steel he's not going to bend. And that's very much how China would describe itself as well. So you have two strong men here, both of them playing this game of who's going to blink first. And it just doesn't seem like there is an off-ramp for both sides at this point. So we'll have to see. One of the big barriers as well is the differences in the way policy is made and negotiations are done in China and US, because Trump fashions himself as this negotiator. He wants to be at the center of the table, striking a deal leader to leader with President Xi. But for China, that's just not the way that the Communist Party protocol works. China would like to have more lower level negotiations. They will only come to a high level president level meeting only when they are clear that there is going to be an outcome that is acceptable to China and not an embarrassment to President Xi. So they view that high level meeting as a culmination of the negotiation process to seal the deal rather than a beginning of negotiation. And that is part of the reason that is causing this impasse as well.
Bloomberg's Min Lo there, along with Jill Desis with the latest on trade and this swift turnaround. And of course, a turnaround is what we're seeing when it comes to these markets as well. Stocks in Asia really extending that relief rally that we saw on Wall Street overnight. We're expecting that when it comes to European trading as well, given that jump in Euro futures of about 9%. This after we saw European stocks falling to their lowest since January of last year as the EU and China retaliated with higher tariffs on the US. That was really seen as a further escalation. But of course, we are seeing broad-based risk appetite returning after the previous day's sell-off, given that we've seen that reprisal for 90 days, even if what happens during those 90 days and certainly after the 90 days remains very much up in the air. We're seeing German DAX futures seeing a lot of upside there as well. More ahead on the Asia trade. This is Bloomberg. Let's get you some market calls that we're following today. And Goldman Sachs economists now think a US recession is less likely after President Trump halted higher tariffs on most nations. They earlier said that a recession was their base case, raising the probability of a downturn in the next 12 months to 65%. But shortly after Trump's announcement, they reverted back to seeing a 45% of a chance of a recession in the year ahead. JP Morgan, meanwhile, expects the Fed will now wait until September to begin cutting interest rates. The chief US economist, Michael Feroli, earlier penciled in a string of rate cuts beginning in June. The bank last week also predicted that the fallout from the tariffs would tip the US into a recession this year. Shery.
Heidi, take a look at some of the movers that we're watching right now. Of course, we have seen the reaction to that tariff reprieve that came from the United States. Although auto tariffs have remained in place, you can see Toyota gaining with a broader rally right now, more than 8%. Nippon Steel also higher. We have heard President Trump say that he doesn't want U.S. Steel to go to Japan, so we saw a little bit of pressure there. But Nippon Steel gaining ground with the broader markets. Also, 7 & I really reacting to their earnings results earlier in the week, forecasting operating profit and revenue for the current year that missed estimates, but still gaining more than 7%. This is Bloomberg.
China wants to make a deal. They just don't know how quite to go about it. You know, it's one of those things they don't know how quite. They're proud people. And President Xi's a proud man. I know him very well. And they don't know quite how to go about it, but they'll figure it out. in the process of figuring it out, but they want to make a deal.
President Trump there speaking after raising tariffs on China to 125% following Beijing's latest move to levy U.S. imports at 84% in response to the previous round of Trump's tariffs. Take a look at what we're watching when it comes to dollar yuan at the moment, and it'll be quite interesting, particularly given there's quite a bit of speculation as to the limitations of tariff and trade-related measures that Beijing can now take, given the one-upping each of the moves when it comes to these reciprocal and retaliatory tariffs. The concern here, of course, is the devaluation of the yuan as one of those tactics that could be used, and potentially also things like looking at Chinese ownership of other U.S. assets, I should say, as well. Well, let's bring in now for analysis Susan Shirk, who's a research professor at the University of California, San Diego. She previously served as the U.S. Deputy Assistant Secretary of State in the Bureau of East Asia and Pacific Affairs. She's also the author of various books, including Overreach, How China Derailed Its Peaceful Rise. Susan, really great to have you with us. At this point, as we see sort of an olive branch, or at least, a window of opportunity for negotiations with much of the rest of its trading partners, the US is doubling down more so than ever when it comes to China. Beijing says it will fight until the end and has been matching those tariffs essentially with every move. Is it hard to see an off-ramp, and is it hard to see the sort of domestic political capital for each leader to be able to be seen to compromise here?
Well, I think that Xi Jinping is not surprised that China did not get a reprieve from the tariffs. And because from his perspective, this is really all about containing China's economic development and technological development. So he feels well prepared. They've been preparing to kind of fireproof the Chinese economy from pressure from the United States, really ever since 2012, since he came into office. And they actually have quite a lot of things they can do. So, I believe that Xi Jinping was interested in negotiating and continues to be interested in negotiating and end to the disputes, but they're not desperate. So they were prepared for an all-out trade war, and they were prepared for negotiating, and they've been playing the playbook for the trade war in a rather impressively competent way, I would say, especially compared to the way the Trump administration has done it in an overly hasty manner, sloppy. But China's been very strategic, very targeted.
Susan, in your book, you write in part about the previous Trump administration and how he came up against presidency in those years. And, you talk about this sort of, aggressive posturing from China and warning of overreach by China, but also overreach by Washington in terms of how much they move to curtail China's competitive edge. Do you think that overreach is what we're seeing now from the second Trump administration?
Well, it's really hard for me to understand what President Trump is trying to achieve. I don't think I'm unique in that respect. But I don't think it's because he's concerned about China as a security threat. I think he wants to do something big, something great with China. So I think this is a pretty good moment of opportunity for China, because I would say that President Trump probably feels that he's more desperate for a deal with China than Xi Jinping is desperate for a deal with Trump right now.
I mean, do you expect other countries also to pivot more towards China as well? Could
Absolutely.
that be an opportunity for Beijing?
Yes, I do think this is a moment of opportunity for Beijing, because no matter what they do, even if they do nothing, other countries are going to come closer to China just because they're feeling repelled by the Trump rash actions. So there's less credibility on the U.S. side, which is really quite bizarre, than there is on the Chinese side right now. However, I saw a headline that suggested China was a safe haven. I wouldn't say China is a safe haven, especially for other private international firms, because the security police in China are still putting Chinese entrepreneurs, foreign entrepreneurs under a lot of pressure. And China is still a kind of Wild West environment in its own way. But on the other hand, if Xi Jinping took advantage of this moment of opportunity to stimulate domestic consumption, which now they're talking a lot more about than they had previously, and that would prevent all these Chinese manufactured products from flooding the rest of the world through overcapacity. I mean, they're going to have to do some of that anyway. And if they could do it as part of the negotiation, that really gives them a lot of good offers to put on the table.
Susan, we continue to talk about this economic decoupling between the U.S. and China, but now we're hearing that Beijing is even cautioning citizens against traveling to the U.S. How big of a risk is this social, cultural, academic decoupling that we continue to see between the world's two biggest powers?
Well, I think it's tragic, and I think some of this is hyped up by Chinese propaganda, but some of it is genuinely felt by Chinese people, because especially in the current circumstance, the crisis we're in, people are really rallying around the flag in China. It's obvious that the crisis has been caused by the actions of the American president, whereas in the past, rash actions by President Xi have really, especially at the end of COVID, really had alarmed the Chinese people, and they were quite critical of their own government. Now they are identifying with their own government, and all the blame is focused on the United States, which is really a shame, because, of course, there are many policies in China that need to be modified in order to improve the welfare of the Chinese people, especially provision of social goods, fiscal reform, and maybe some of these things will happen now, which would be taking advantage of the opportunity.
Susan Shirk, good to have you with us, research professor at UC San Diego. We have more to come. This is Bloomberg.
Take a look at how we're shaping up when it comes to US futures, as well as that key sort of element of how we see the more sort of China exposed or mainland as well as offshore Chinese markets respond, given it is a broad update, of course, in that relief rally that we see after we saw that pausing of higher tariffs against most nations, but of course further upping the rate on China to 125% on some Chinese goods there. We've seen quite a lot of hefty gains, particularly when it comes to Japan, South Korea, but also Australian markets also playing catch up there as well. And in fact, we saw that commentary from the Prime Minister Anthony Albanese saying that the fact that we're seeing this market rallying is an indication that these tariffs were economic self-harm, end quote. But take a look at what we're watching. S&P futures looking a little bit muted at the moment after what was really a big session overnight. The soaring when it comes to stocks, particularly when it comes to tech, seeing that big recovery, and the biggest again for the S&P 500 since the global financial crisis in 2008. TAIEX futures looking pretty positive. Of course, Taiwan has been one of the really hard-hit tech-heavy gauges, particularly when it comes to exposure to that supply chain story with China and broadly with the chip story there as well. We've had talk of potential intervention there in Taiwan. We're seeing some upside there. FTSE A50 China futures actually also seeing, when it comes to the last trade, not a terribly bad picture there either. Well, let's bring up Bloomberg Equity senior reporter Abhishek Vishnu, who joins us now from Singapore. So you can see, as expected, the follow-through when it comes to this relief rally. The question is, I guess, what happens for this 90-day pause, and does volatility persist because markets and investors will just be reacting to whatever the latest headline and news flow is coming from the presidency?
And that's right. Volatility would persist. Or even on the upside, you are seeing, circuit filter mechanism triggering in South Korea because the futures rose more than 6%, about 6%. We are seeing Japan also rallying about 7%. But what has happened is this about face by Trump on higher reciprocal tariffs. This sort of rescinds the probability of a U.S. recession, and therefore it is net positive for all risk assets. Asian equities won't be any different, but the guys who had fallen the most and the countries which had started reacting the most initially, they would be benefiting the most probably. Our strategists believe that Taiwan, ASEAN, even India, they are well poised to gain from this pause of 90 days on higher reciprocal tariffs. Now, for China, it's a little bit, the case a little bit convoluted, but it's not net negative. China is already focusing on domestic demand stimulus, but Trump has on the record said that, there are certain American companies, large companies, for which, he can give some sort of leeway on tariffs. And all those supply chains in Asia, and China is the factory of the world. So there is some expectation that even China benefits from this. But as Morgan Stanley nicely put it, this setup is probably most bullish for Japanese equities, right? Because Japanese equities had priced in a recession way early, yen is weakening, dollar is rising, but it is least bullish for China. I mean, it's still bullish for China, but least bullish.
Yeah. I mean, we saw the Golden Dragon China index overnight on Wall Street actually be pressured. And with this continued chatter of perhaps yuan devaluation, what are the long-term prospects for Chinese assets?
But the long-term prospects for Chinese assets remain the same. I mean, you can't really, carve out China out of the Asia story. And China has had started de-risking itself from US a long time ago. They are not as much directly involved in the U.S. economy as they used to. But, it's part and parcel of a lot of supply chains across Asia, across the world. Europe has also become a big market for them. So China, in terms of what the role it will play in global portfolio, I mean, our reporting has been reflecting for the last few weeks that there are two things that China has to offer. One is tech at a cheap price, probably, even replacing Mac 7 as favorite bet for consumer tech or, AI. Chinese stocks are trading very cheap, and we still have DeepSeek's Afterglow to enjoy. And second is yield. China's banks, many other stocks are giving a lot more dividends, conducting a lot more buybacks, because government has been focusing on this. From common prosperity, they want to focus on new productive forces, corporate governance. And we have seen this cycle playing out in Japan and to some extent Korea. So China's role in global portfolio would be tech and yield.
Bloomberg Equity senior reporter Abhishek Vishnu there. Well, President Trump has called the bond market a thing of beauty, but for traders of government debt, the U.S. session was pure mayhem.
I was watching the bond market. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. But yeah, I saw last night where people were getting a little queasy. I think everything had. Well, the big move wasn't what I did today. The big move was what I did on Liberation Day.
Case in point, the yield on two-year treasuries jolted higher by as much as 30 basis points after Trump announced a pause on his higher reciprocal tariffs against most nations. For more on what signals we're getting from the bond market, let's bring our executive editor for Asia markets, Paul Dobson. Paul, one of the comments was there's been a no-win situation when it comes to trading, regardless of whether the mood is risk on, risk off, and surely that changes at some point, you know, from almost hour to hour, if not more quickly. How do you characterize it? Because we've also heard from Scott Bessent saying that this is just, you know, normal deleveraging that we're seeing.
Good morning, Heidi. I think this is far from normal in terms of the sizes of the moves that we're seeing in the yields. I mean, pause and think about it for a second. The two-year yield jumped 30 basis points in the session. That's pretty astronomical. That's more than a whole Fed interest rate hike. So like jumped over that two-year period right away. And that's the problem that bond markets are having to deal with at the moment. All of this volatility. The first part of the week was really focused on the back end of the yield curve, 10-year to 30-year bonds, which sold off very aggressively and saw really huge gyrations in those yields. And that is the sort of thing that policymakers really can't stand, that really gets them worried when you see really big moves in long-term yields because of the impact that it has on borrowing costs for the entire economy. And that, you know, we heard from Trump he was paying attention to it, and clearly that was a factor that was weighing on his mind as he made that decision to pause the implementation of the extra tariffs. For bond traders, though, you know, that may have given us a rally back in the back end of the yield curve, but it's pushed up those short-term yields instead. So you've just basically got the bond market pivoting one way or the other. There's some pain to be felt there. And I think the longer-term impact is even more important because heightened volatility in bond markets is the last thing that people that invest in bonds want. It doesn't give you certainty. It doesn't give you a store of value and safety and a sense that you've got a risk-free asset, which is what bonds are priced for. And also it doesn't help in the corporate bond space where issuers are trying to price deals in the market and facing this extreme whiplash as well. So far from ordinary and very inconvenient for large parts of the global investment community.
Yeah, and the key word is safety, right? Where do traders go for protection? Have we seen any alternatives really coming to the fore, given, of course, this perhaps a little bit of a lost confidence in treasuries at this point?
I think it's a great question, and a lot of the havens that people would turn to really haven't been performing this week, and that's been a big cause for concern as well. Not just government bonds, which have had all of this whipsaw, but gold has not always been rallying the way that you might have expected. That seems to have topped out for now. There are reasons to dislike the Swiss franc, although that has been performing pretty well. Negative yields being one thing there. And the yen has its own sort of wobbles and consternations and isn't always reacting perfectly as a haven either. The dollar, you know, which has effectively been a haven for much of the last few years, also losing that sheen because of the withdrawal from US stocks and treasuries that we saw this week. That's when people needed a haven. Right now, of course, you don't want that haven because we've got a massive rally going on again. But if the mood darkens, it's still going to be difficult for people to work out where to hide. And I would have said, you know, very short-term bonds would have been a good place to go. That blew up in everybody's faces yesterday as well.
Right. Bloomberg's Paul Dobson there with the latest market gyrations as we also continue to watch the commodity and energy markets reacting to President Trump's tariff pause. Oil, gold, copper, all trading higher. Let's bring in Bloomberg Managing Editor Clara Ferreira Marquez. Clara, of course, we continue to see the gyrations in the markets. Commodities at this point, when it comes to Brent, a little bit of downside pressure. But of course, after that rally overnight on that risk on sentiment, where can we expect the broader markets to take commodities at this point?
I think it'll depend a little bit on the commodity. What we did see overnight was a sweeping sea of green after many days of red, particularly strong in metals as well, so copper, very strong in Brent and WTI. And this morning we're seeing it a little bit steadier. Still higher in oil, still higher in copper, opened very strong, still higher in gold, but steadying a little bit. Remember, this is only a temporary pause. And very strong tariffs remain on China, 125%. And China is, of course, the largest consumer of the world's commodities.
Which is particularly interesting if you see that surge that we're seeing in copper, right? Because you would think, well, surely the dominant narrative there is still the threat of Chinese economic weakness.
Well, I think a lot of that will depend on what some of your previous speakers have just been talking about, the extent of the stimulus. China does still have levers to pull. There has been some opportunistic buying in the metal space, and particularly in copper, so we can expect that to be holding things up. But of course, a lot of what we're seeing now is still relief after several straight days of severe losses.
Bloomberg's managing editor for commodities and energy in Asia, Clara Marquez there. We do have more ahead on the Asia trade. This is Bloomberg.
Take a look at how emerging assets are trading. We have seen that rebound on the EM stocks after we saw President Trump pausing some of those tariffs. We have seen those gains being led higher by Brazil's real, the Mexico's peso, as well when it comes to that currency trade. Of course, two of those countries, some of those countries that will get really hit hard by some of those tariffs that President Trump is putting in place. But you can see right there, Haidi, the MSCI Emerging Markets Index year to date is still down more than 6%.
Yeah, regardless of the moves that we're seeing today, right, we are seeing some of the sort of Vietnam-linked Asian stocks seeing a jump in this session as we saw that pause and higher tariffs for 90 days. Of course, Vietnam was one of the hardest hit when it comes to those reciprocal tariff rates and is a major manufacturing hub there for a lot of Asian countries. But we have also heard some positive progress when it comes to Vietnam and the US agreeing to begin negotiations on a trade agreement. The Deputy Prime Minister from Vietnam meeting with the US Trade Representative Jamison Greer in Washington, agreeing to kick off talks on a reciprocal trade agreement. So we'll continue to watch that. Let's get you caught up to date with some of the corporate headlines we're following. And the world's largest toy maker says it's not daunted by the tariff uncertainty as it opens a new factory in Vietnam. Lego plans to invest $1 billion over 15 years in the complex, which will produce toys for Asia. CEO Niels Christensen told us that they see growth in new markets as a buffer against any possible headwinds from tariffs.
We typically produce within the region that we sell to consumers. So basically most of what we sell in the US we produce in Mexico, or in the future in the factory we make in Virginia. Like this factory in Vietnam is then to serve Asia Pacific together with the factory in China. So in that sense we're a little bit more resilient than most companies up against tariffs. So in that sense we as a group will probably be able to cope pretty well, and it won't have a big influence on what we do.
Amazon has cancelled orders for several products made in China and other Asian countries, a document cited by Bloomberg. And comments from other sources show orders for beach chairs, scooters, air conditioners from multiple vendors were halted after Trump's tariff announcement. That is it for the Asia trade. Our markets coverage continues. The China show is next.